Head of Portfolio Management Services and AIF Investments at ICICI Prudential AMC joins us now. Anand, good morning. Thank you for joining us. We've done very well for ourselves. The world is falling apart post Jackson Hole, but Indian markets have done rather well for themselves. The outperformance is real, outperformance is good, but is it here to stay?
Hi, very good morning. And I think it's an delight to see. You also spoke about the breadth. We are seeing fairly decent breadth, and that also reflects in the earnings also. So I think the one key point I would want to make here is that unlike rest of the world, India has been sort of fairly, yes, we do have some of the imports in the form of oil and gas, which are hurting us, but the coal prices have been stable here. And to that extent, the energy hit has not been as that great. But more importantly, if you see in last 2-3 years, we have seen a very broad-based earnings recovery, which was sort of lacking for almost few years. If you remember, we used to start with a 15% Nifty earnings growth rate every year. And for almost for a few years, we used to end with a flat Nifty earnings growth rate because a part of the economy was doing well, which was the erstwhile B2C businesses. But manufacturing, mining used to seriously struggle through that last 5. I think that has changed. In last 2 years, we have seen a very broad-based earnings recovery led by manufacturing, mining, and other sectors. Also, apart from B2C businesses, which continues to provide a stable earnings growth.
Everybody is now suddenly talking about cyclicals, real estate, banks, and industrials. At the beginning of the year, the crowd was talking about IT, metals, and pharma. 8 months and the world has changed 180 degree. What is real? The one we saw in Jan or the one we are reporting right now?
No, I think we've been consistently maintaining that some things have changed. Look, last almost a decade, you had China, which was having overcapacity in manufacturing across, whichever from safety pin to boilers, whatever you want, you didn't have to manufacture in this country. You could get it cheaper, maybe better from China. And that applied not only to India, but the rest of the world. I think that is changing. Uh, Part of that is cyclical. So, there is a lot of, manufacturing disruption in the Northern Europe, to some extent in Ukraine, and to a large extent because of sanctions in Russia, but also China over last few years have been, uh, you know, very, very focused on pollution. And to that extent, they have also been letting go a lot of energy intensive, a lot of CO2 intensive manufacturing, which has been, sort of, and to that extent, whatever has survived in manufacturing, he's been doing well. You spoke about banking. I think banking was also one. So there are two parts to the banking. One is the secular part of the banking where the Indian consumers continue to borrow and they remain a good credit. But I think for a few years, we also had a lot of credit issues in the manufacturing and infra. And you can't speak enough about the pain that the PSU banks in particular, but generally the entire banking system took. That is also reversing. So we have provided for those loans which have turned bad. And now if you see every week, every other week, we have some resolution, some recoveries happening. So banks also have a secular recovery from retail loans and housing loans. But even we will see some capex cycle picking up that will create some credit opportunities. But most importantly, the credit cost, which was sort of a drag for all these banks in terms of earnings and return on equities, I think that's entering the other on the other side of the swing where it can actually be better than the average for a few years as recovers will be good and the slippages will be far lower.
And the new flavor in the market clearly seems to be anything and everything to do with defense, logistics, the entire infrastructure and ecosystem around it. Wanted to understand what are your thoughts here, because as I see, you too have, a Hindustan Aeronautics, for instance, in your portfolio.
So, Bengal, I think first and foremost, one will have to take a cognizance that there is a change in the trend. I think for last decade, you didn't want to touch manufacturing generally. I think that's changing, slow but steadily. But world needs an alternative to China, and India this time around is more prepared than before. I'm not saying the battle has been won, but I think if you have survived the carnage that happened in manufacturing ex China in last decade, then you're anyways good. Now it's a time for you to make the most of recovery in manufacturing ex China. I think that's very important. So and that also helps the manufacturing allied. It's not only logistics; it's also uh, cap goods. So if you see a sort of order booking that a lot of cap good companies are showing up, that also reflects the balance sheets for manufacturers have deleveraged. So they're also ready for doing capex. Whichever way I look at it, I think there is a change in trend. Maybe it's early days, but I think we will enter a phase where India can not only export IT services, but we can also a very decent size exporter in the manufactured goods. I think we are keeping a very close eye on that. Then the logistics, the defense. I think defense is another area where we had an underinvestment globally, and we will see to some extent there will be a lot of investment globally, including India. And while India itself is a very large market for a lot of these defense companies, but there are also opportunities outside India, in Southeast Asia and other smaller countries, where can use the India as a cost-effective manufacturing base for some defense exports also. So broadly, I think it's more bottom-up. We will have to take each company and understand whether they are participating in this recovery in the overall manufacturing scenario. The supply chains are getting shifted, and India is becoming integral and a critical part for many a supply chain companies. We are seeing many an MNCs already shifting some bit of manufacturing from China to India, which reflects sharp exports growth rate for many a manufacturing MNCs already.
Sure. The other interesting sector that I spotted amongst your bullish bets was also textile. Wanted to understand whether it's pure play textiles or is it the quasi retail plays, the likes of a Trent, Aditya Birla Fashion, etc., which interest you?
Yeah, I think the two parts of the textiles. One is obviously consumer facing, which obviously was hit by pandemic, but that was one secular story in India. With rising per capita income, there is no way to say that we'll consume more. So that's again a secular stories which is there. I think the interesting part and the part which is underappreciated is India's cost competitiveness in cotton textile manufacturing chain, starting from yarn to fabric, which is both knits and woven, and all the way up to garmenting. Yes, last year has been exceptional. For first time in many years, cotton in India was more expensive than rest of the world. That's not happened often in my 22 years of career that I've observed. So I think once we have some clarity on the cotton crop this year, I think this value chain, which is reasonably priced, but more importantly, can play a large role. As again, as I was saying, there is a diminishing role for China in many of these capital intensive is not an issue, but the people intensive, the labor intensive industries. And that's where India has an opportunity to create jobs. I think it also solves one of the India's problem, which is we need to provide employment to such a large population, which is entering the working age. So I think textiles is very critical for government. So we always see policies which are conducive because they create a lot of jobs. But as I said in the beginning, I think India has also a cost advantage. India also has a right to win with the cotton supply chain.
Good morning, Mr. Shah. Just building forward from what you're saying, and look how bullish you're sounding. And that is something that we've been talking about in India, right? McKinsey Global CEO saying, forget a decade. This is India's century. The kind of growth that is being possible over here, the resilience also that we are seeing. The question I want to ask you is that when we look at today's Nifty levels and we say, okay, maybe we'll end the year at 18,000, 18,500, What about 21,000, 21,500? We had Atul Suri, a marathon yesterday on the channel, saying he sees those kind of levels within a year.
I think I would like to definitely make a point here that the macros have been never as difficult as they are today. And as an equity market investor, I can't ignore what's happening in the rest of the world. So yes, there are enough and more challenges when you look at macro, when you look at top down. And that also reflects in select sectors like IT and others, which are sort of seen a very, very sudden slowdown, which was not expected. So I think we are part of a global world, and even the flows. So we need to be cognizant that a lot of ownership of the Indian equities is sitting somewhere in the foreign land, and the happenings of the world also will impact flows. We've seen enough and more FI outflows last year, last 12 months. It's just turned in July. But for the 12 months ending June 2022, it was a large outflow. So I don't think we can undermine that there are challenges. So when I was responding to the previous questions, yes, there are bottom-up areas, there are opportunities, but they will come with their own cyclicality. They will come with their own challenges, and that's why it's very, very important that we always keep an eye on the risk. There is no doubt in my mind that this market is not going to be one way. There's no doubt in my mind that this market is not going to be challenging in times to come. We will be questioning all the theses that we've been talking about when the markets will be down 10% from here. So I think from the investor's perspective, I think we are not taking our eyes off the risks that exist in the marketplace, and I don't think investor can afford to take the eyes off the risk when he's investing into equity markets.
Okay. So you're still very, very cautious given the macros that we're seeing. One of your bullish bets has to do with metals. Given what's happening, there's all this chatter about maybe it's time to reduce that soft landing, hard landing. Will we see a recession, growth recession? That's not going to impact the metal pack. We've seen prices also starting to come down considerably.
Indeed, I think there's no doubt that the metal prices are fairly elevated, and to that extent, there was bound to be correction, and that's what we are seeing. Having said that, again, I draw the same analogy where I'm saying, look, while the metal prices will not remain fairly elevated, but we believe the next decade, in many of these commodities, the prices will be higher than the previous decade. Again, reason being the same, that there has been significant underinvestment in manufacturing, in mining, in manufacturing. And Indian many metal companies are actually a mix of mining as well as manufacturing. They have iron ore mining, they have bauxite mining. And to that extent, I think one needs to keep in mind that these companies over the last 10 years, especially at the end of 2008, 2010, were left with a massive correction in the commodity prices with a very leveraged balance sheet. They had expanded greenfield, they had done acquisitions globally. Today, as we stand, many of these companies have deleveraged balance sheet. They've corrected their global, acquisitions in terms of debt and divestments if needed. They have also invested in the geographies where they were strong, like India, where they had inherent advantages. So I think it's more of a bottom up. I won't say that we are in a phase where we are in a super cycle, definitely not. But at the same time, I would say that the metal companies in India can be part of a solution. Today, when you're seeing Northern Europe hit by a very high energy prices, have to cut down on metal production. China, with its focus on reducing pollution, reducing CO2, is sort of reducing their net exports, wanting to reduce their production in an energy intensive. I think India can be the part of solution, and that's where I'm looking at which of the Indian companies, including metal companies, are part of a solution where the world is disrupted because of China, because of Russia, Ukraine, because of Northern Europe energy prices, because of COVID. So wherever the opportunities are there.
Anand,
Again, these are all bottom up.
Anand, thank you so much.